Now, to put this all in perspective, especially how the Reserve Bank might act next week and into the future, let's bring in here Sally Auld, Chief Investment Officer at JBWere and a long-time watcher of the nuances of our central bank. That's true, isn't it? You have been watching the central bank for a long time. OK, so given what's taken place in the United States, given the place with what we've seen here in inflation, just tell me about the thinking of the central bank in terms of trying to control inflation here in Australia. Is a job done or not?
Not quite yet, I think. And so we saw the Fed last night, they raised rates. That was broadly expected, but they were very non-committal about the future. So Jerome Powell, the chair of the Federal Reserve, didn't really give any strong signals. He said when the next meeting comes around in September, we will have 2 more inflation reports, 2 more jobs reports, some new numbers on wages, and we'll sit down, look at all of that, and then make our decision. So he left the door open to doing nothing or to potentially hiking again.
But the difference between the United States and Australia is that the US already has its inflation rate well under its cash rate.
Correct.
We don't have that situation here. Now, does that weigh on the thinking of the central bank here in Australia?
So I think there's 2 things going on. So I think you're really right to identify that there are differences in how far the Fed has taken things and where its inflation trajectory is. Here in Australia, we've made some progress, but I would argue not enough. And the problem for the RBA is that we have this set of quite idiosyncratic challenges to the inflation backdrop here in Australia that other countries don't have. So rents is a big one. We know that. They were up 2.5% in the second quarter, the biggest quarterly rise in at least over a decade. We have the possibility of El Nino and drought, reduced agricultural output, higher food prices. We know what's happening to energy bills right across the eastern seaboard in Australia from the 1st of July. They're up anywhere from sort of 20 to 30%, depending on what state you live in. And then on top of that, we've got this issue where wages growth has accelerated, but productivity growth has not. And that's pushing up what economists call unit labour costs. And that tends to be one of the medium-term drivers of inflation. So while the RBA got good news yesterday on inflation, it was better than they had forecast. The problem is they know that for the next couple of quarters at least, the news isn't going to be so favourable.
Right. So that means the job is not done, you would say. Then we've got an earnings season that pretty much kicks off big time next week. And in the face of all this, businesses are having to try and work out which way it's going to go. What's consumer demand going to look like over the next 6 to 12 months? What are business conditions going to be like during that time? Where will interest rates be? Where will their costs and inflation be? That makes it quite uncertain for investors trying to get a steer on which way the markets might move with all this.
Absolutely. And so I think you're exactly right. The outlook is going to be quite challenging. And I think for a lot of companies, we might see some of the guidance for next financial year probably come a bit lower amidst all of that uncertainty. What's interesting about the profits for the first half of calendar 23 is that on many metrics, the economy did really well. So if you look at the unemployment rate, it hung around 3.5%, give or take, sort of record lows. That sort of suggests, all things equal, pretty good economy.
And consumer spending did not fall off a cliff.
That's right. So consumer spending has sort of held up okay. I think some of the anecdotes we're hearing at the moment are telling us maybe in the last month things have softened, a bit more quickly. But generally speaking, felt like the economy was doing reasonably well. And so that does make me wonder whether actually for a number of companies, maybe the risk is that actually earnings that have been banked look okay, but it's really the next 12 months where we might be starting to worry about profitability.
Some of the big influences on the Australian economy, and it's really interesting seeing from overseas, China, for example, not giving a massive stimulus program as expected, starting to weigh on the big iron ore miners. We saw Rio Tinto's results this week. We start to see BHP in the next few weeks. And of course, these are big powerhouses in terms of driving our stock market.
Yeah, absolutely. And so I think the market probably got a little bit ahead of itself the other day when we had some pretty modest announcements on stimulus, but that was received well by the market, and we saw commodity prices up, share prices of our big miners up. I think our sense would be that both the short-term and medium-term growth outlook for China remain quite challenged. And as you said, the authorities over there have a different way of dealing with that. They will stimulate the economy in order to put a floor under growth, but they're not going to stimulate it with these huge packages like we've seen in the past in order to sort of put a rocket under the economy. And that's a very different operating environment, I think, for not just the global economy, but our big miners as well.
And bring it back home here to Australia with everything, as you say, sort of holding relatively firm for this reporting season. A lot of that, I would suggest, has got to do with the unemployment rate being so close to 50-year lows. While people have got jobs, they can cut back at the edges, but broadly they can keep themselves in play. It's when unemployment rises, you can have some fundamental issues.
That's right, because your cash flow stops.
Yes.
And we know that it's actually, if you talk to bankers who were around in the 90s, like a long time ago, but the last recession, what they'll often tell you is it's not really the level of interest rates, it's what the unemployment rate does, because you're exactly right. People do whatever it takes to pay the mortgage, and you can do that if you have cash flow. But if the unemployment rate starts to rise, and on many indicators, that's what's likely to happen over the next 6 to 12 months, that probably does create some distress.
But just finally, even the banks themselves, their share prices, they've kind of hung in there on the anticipation at some point down the track, interest rates start to fall.
I think it's a combination of that we're getting close to the end of the tightening cycle. And then also there's been a bit of a narrative, I think, in the last couple of weeks after some good US inflation data that maybe central banks can deliver the fabled soft landing. And so that's given a real boost to the cyclical parts of our stock market, of which banks is a big one.
I'll tell you what, Sally Auld from JBWere, always good to have on the program. Many thanks for your time today.
Thank you, Ross.